Welcome viewers, and Inmode have released their most recent financial results. So we're going to have a look at what those results are, and I'm just going to take you through my thoughts on what that means for the company. I'll do a bit of evaluation just to see whether I'm going to be adding more to my portfolio, and I'll share with you my current position. So Inmode's latest results, and we're going to start right now. Okay guys, so here are Inmode's latest results as of May the 2nd, so pretty recent. And this is their first quarter, fiscal 2022. So we start off with some good news. First quarter revenues up 31% compared to the same time last year. Now the net income has gone up to 31 million for that period, although not in proportion to the revenue increase, so quite as high as 31% up. Earnings per share 36 cents versus 31, or non-GAAP 40 versus 34 cents. So a good trajectory there. And the good news is their consumables and service division is up 80% compared to a year ago, although still only 14 million. That's still pretty decent compared to the 86 million overall. So not only are they just selling these devices perhaps as one-offs, but they're actually then got these consumables to go with it, which I think is a really good business model. And if you look at what GoPro is doing on their side, this kind of thing, you look at people like Adobe, that kind of service and consumables thing is a really important part of the business. So cash and cash equivalents is $400 million, which is a pretty high amount given the market cap, which we'll see later on. So gross margins are high, dropped a bit down to 83%, but that's still pretty high gross margin. And in fact, they've called this out in terms of operational challenges with relation to their gross margin. So it looks like operationally the management so far has executed really well. They've mitigated some of these supply chain issues and shipment price increases. That's great news. So much so that they are reiterating their 2022 guidance. So by reiterating that guidance, that should give a lot more confidence in the business and its ability to continue performing throughout this year. Importantly, they're not just resting on their laurels and their products, they are continuing to innovate, because a very important thing here is innovation is key for this company with these treatments and products in order that they can continue to maintain this really impressive performance. Now, I should note that the US is still their main market. Revenues outside in the minority, which is 38%, decent proportion, but they're still very much US, Western Europe focused business. The operating margin is broadly flat from the prior year, so that's pretty decent. So looking forward, they are suggesting revenue in the $450 to $425 million range, with that non-GAAP earnings per share just over $2, or around about 200 million in operating income. Now, looking at this, non-GAAP diluted earnings per share 211, current market price is around about 22, so that's a forward PE for this year alone of 10. That seems pretty decent to me for a company that's growing and has massive margins like this. Just a quick note on the cash and cash equivalents. So we saw 400 million. Of that, almost 300 million is marketable securities. So do be aware of that. It's not pure 400 million in pure cash terms. Other thing to note is that they purchased with share buybacks over $40 million worth of shares. So that's, so that all looks pretty decent. We look at the earnings trajectory. They consistently beat analyst expectations. The trajectory here over the long term, the medium term really, is that revenue and earnings growing massively. Very high margin and high growth business, which is a rare combination indeed, particularly one that's doing share buybacks. The return on equity is very high, well over 40%. That's a really important figure, as is the return on invested capital, which is very, very similar to that figure. And those net margins look high 30s to 40%. Now, you should note that the tax rate there showing on Morningstar is very low, and I think they've had some sort of tax rebates or not had to pay tax previously. They're now starting to having to pay tax. An increased value of tax will impact their free cash flow. But the current free cash flow is $181 million, so that's quite a useful number to have a look at later. So there's very minimal capital expenditure here, so all of their operating cash flow is effectively being translated to free cash flow. So they're growing well, they're profitable, it all looks quite good, but let's have a look at the balance sheet, because we want to know what the chance of failure is. And that balance sheet is spotless, there's not a spot of debt on it. So I'm looking at a company here that if there's any tricky times ahead with inflation, perhaps recession, perhaps their performance in the short term will be impacted. We don't know what will happen, but certainly the chance of failure here is very, very low. The other thing here is individual insiders do own around about a sixth of the company. Now, looking forward, the analyst pool in Yahoo is suggesting a 33% a year growth in earnings for the next 5 years, which is quite optimistic. We've got 11.7% on Simply Wall Street, and I want to use that lower figure to be conservative in the valuation that I'm doing. So if you stay tuned to the end of the video, I'll be giving you my view of the valuation. Not financial advice, of course, just my opinion, so don't act on what I'm saying here. So look at this. Now, we were topping out here almost $100 a share around about 7 months ago, and we've dropped all the way down to 21. So we've lost around about 75% of the stock market value of the company. Of course, that doesn't mean the intrinsic value has dropped 75%. So we're looking to identify those mismatches between intrinsic value and the market price as potential buy opportunities. The market cap's about 2 billion at the moment. The enterprise value is seen as 1.6 billion because of the cash and cash equivalents. So by buying this stock at the market price of around about $22, you're actually getting $5 in the cash and cash equivalent per share already. So that's almost a quarter of the value of the company, which is pretty decent. Now, Yahoo's saying actually 4 million of debt here, so it's slightly simply bullshit. I couldn't see debt on there. That's a negligible value anyway. And yeah, just to let you know, I do have skin in the game. So I've had a look at this company. It's a great company. Results seem on track. And I have been buying. So these original prices here were before the 2-to-1 split. So I've been buying as it's dropped. And it's now dropped. And I've bought today at $21.83. I've added to the position. So this is ShareSite, by the way. So if you want to keep track potentially across different portfolios of your exchange rate impacts, the different buying points, if you want your brokerage accounts automatically linked potentially to ShareSite, and you want to see your compound annual return and compare it to a benchmark, then this could be the platform for you. And if you're after 10% off, then if you kindly use my link in the description below, you can get 10% off. And I get a small credit as well from ShareSite. So appreciate that if you're interested. Okay, guys, so here we have the world famous Finance JCL calculator. So I'm going to do a discounted cash flow model here. I'll be very conservative with my figures as well, just to build a bit of a margin of safety into those calculations, because these are all assumptions and the answer that comes out is only as good as the data that goes in. Going up 5 years ahead, we'll use a discount rate of 15%, which means I want the stock price to double, also my return to double in 5 years. I'm going to go with a terminal multiple of 15, so a nice kind of P at sale. Keep that nice and low. Current P is 12, but if they perform well, 15 is probably on the reasonable side for a medical devices company. Got market cap of 2 billion there, share price around about 22, and they've got 83 million shares outstanding, and that free cash flow of $181 million. So Simply Wall Street had 11.7% growth, so I'm going to start with 11. I'm just going to tail it down. Growth companies' growth starts slowing, so going from 11% down to 7% in the final year of our simulation. So that gives us an intrinsic value per share, in my opinion, of 37. So that means that if the share price in the market was $37 per share for Inmode, one could expect, at least based on my calculations, if they were right, a 15% per year compound annual return, so doubling in 5 years. The upside to that from the current price of 22 is 68%, just to get to that doubling. So it suggests a very nice margin of safety. Now, of course, you might say, well, the terminal multiple 15 is too high. Even if you went at 10, I think final P essentially of 10 is really low for a company making such large margins. Still got an intrinsic value of 28, which means there's still a margin of safety from doubling your money in 5 years. So for me, the downside is really low, in my opinion, for this stock in terms of the lack of debt. They keep beating analyst expectations, high margins, great return on equity and invested capital. So that's why I bought more today and will continue to build up my position over time, particularly with the price of the low 20s. And if it starts getting even lower than that, then I'm going to add even more. So I think it's a great company at a great price. That's just my opinion. I'd be really interested to hear what you've got to say. So do click down into the comment section below and share with me your thoughts on Inmode. If you're looking for a dividend stock to complement this fantastic growth stock, if you hit the link on screen now, you'll find out some of the best high yield UK dividend stocks that are on the market at the moment, everything with a yield of over 5%.